Hi guys. Today we will analyze General Mills stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Compared to the overall market, the stock is an average performer. Both the short-term and long-term trends are positive. Strong support levels are around $68.80 and $66.70. Next strong support levels are around $64.30, $62.58. Strong resistance level is around $69.90. Next strong resistance level is around $73.50. In the last month the stock has been trading between $65 and $74 range. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 3.7 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 3% per year, for last 5 years. We see that the average profit margin of the stock has been around 12% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 119% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for General Mills Company: bad, average, and good. First scenario. General Mills will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 1%. Future profit margin would be low, 11%. Future free cash flow to net income rate would be low, 70%. In this case, the fair value of the stock today would be $66. Second scenario. General Mills will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 2%. Future profit margin would be average, 11.5%. Future free cash flow to net income rate would be average, 75%. In this case, the fair value of the stock today would be $77. Third scenario. General Mills will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 3%. Future profit margin would be high, 12%. Future free cash flow to net income rate would be high, 80%. In this case, the fair value of the stock today would be $89. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 3.75. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For General Mills, analysts forecast growth rate around 3% per year in next 5 years, and future P/E around 18. Again, I will use 3 different scenarios for General Mills Company: bad, average, and good. First scenario. General Mills will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 1%. Future P/E would be low, 12. In this case, the fair value of the stock today would be $21. Second scenario. General Mills will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 2%. Future P/E would be average, 16. In this case, the fair value of the stock today would be $30. Third scenario. General Mills will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 3%. Future PE would be high, 20. In this case, the fair value of the stock today would be $42. As you can see, today the stock is overvalued, $69, even if we expect the company's high performance in future. While General Mills has a good profitability rating, there are some concerns on its financial health. Also, the stock is expected to show a very small growth, 3%, in the next 5 years. Based on that, the stock looks overpriced at the moment. I may consider buying the stock for the dividend, 2.95% yearly, when the stock drops below $50. Company's strengths. General Mills is a leading American multinational manufacturer and marketer of branded consumer foods sold through retail stores. The company markets many well-known North American brands, including Gold Medal Flour, Progresso, Betty Crocker, Yoplait, Nature Valley, Pillsbury, Cheerios and the other cereals. General Mills expects at-home food demand to remain above pre-pandemic, with more people working from home, and an increased number of families cooking and baking. Management is working to create a differentiated portfolio of brands for health-conscious customers, and to generate a higher percentage of revenue from new products. In 2018 the company acquired for $8 billion, Blue Buffalo, a maker of premium pet products. General Mills' pet food business should benefit from the high single-digit increase in pet adoptions during the pandemic. General Mills has a return on assets of 7%, return on equity of 23% and profit margin of 12%. This is amongst the best returns in the industry. The company also has a strong balance sheet now that debt leverage has been reduced to a more manageable level. Risks. The biggest concern is relevance. Consumer tastes are increasingly turning from packaged foods to meals and condiments that are fresh, local, natural and organic. In the process, many shoppers have found alternatives to traditional packaged foods. General Mills and other consumer products companies compete intensely with each other and must also contend with private label brands at a host of retailers, including value-focused stores like Costco, Aldi and Trader Joe's. E-commerce and an increase in digital marketing have lowered competitive barriers to entry for categories General Mills plays in. Inflation and supply chain challenges are themes we're seeing across the packaged food industry. The company has been increasingly reliant on acquisitions for growth, which adds integration risk, and is generally costly, as evidenced by diluting return on invested capitals, including goodwill. The company is not financially healthy enough, and could expect problems in meeting its short-term obligations. Based on estimates for the next 5 years, General Mills will show a small growth in revenue and earnings per share. The EPS will grow by 3 to 6% on average per year. The revenue is expected to grow by 2 to 3% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.